Yes, so I want us to look on how we prepare the group accounts, specifically whereby the parent company has invested in an associate, or basically has invested in what? In a joint venture. So the first thing we need to ask ourselves here is, what is an associate? What is basically a joint venture? Those are the two terms we need to define. Let's start by defining what is an associate. And basically here, when talk about an associate, we say that this is a company, or in other terms, is an entity in which the parent company exercises something called significant influence. So an associate is an entity in which the parent company exercises significant influence. So what do you mean by the parent company exercising significant influence? Exercising significant influence means that the parent company here is not in a position to control the operating and financial decisions which are made by this company, but the parent company is purely in a position to influence. Is purely in a position to influence the operating and financial decisions which will be made by the associate. So therefore, when we talk about the significant influence, this is the ability. It is the ability of parent company, ability of a parent company to influence operating and financial decisions, decisions of associate. So meaning that the parent company is not in a position to control the operating and financial decisions which are made by the associate, but the parent company is only able to influence. Now, in this case, the parent company is deemed to have acquired a significant influence, whereby the parent company acquires shares, or acquires equity or ordinary shares, which lies between 20% to 49%. If, for example, here we are told maybe a parent company or an investor company has acquired shares which lies between 20% to 49% of the shares issued by another company, the other company here will be known as what? The associate, in which case we are saying that the parent company one is not in a position to control the operating and financial decision of this associate company, but the parent company is purely able to influence the operating and financial decisions to be made by this particular associate. So that's what we mean by associate. What, on the other hand, or basically on the other hand, joint venture basically currently is known as a joint arrangement. So therefore, you can say, let's just use the current name, that is the joint arrangement, which was formerly known as joint venture. Formerly, this was known as what? Joint venture. Formerly joint venture, but the current name is the joint arrangement. So when talk about a joint arrangement, on the other hand, this is basically an arrangement between the parent company and another entity to acquire something called a joint control over another entity, entity. So therefore, we are saying that this is an arrangement. This is an arrangement between parent company and another entity, to acquire something called a joint control. To acquire something called a joint control. So what do you mean by acquiring a joint control? Joint control means that the parent company here, and this other entity here will acquire 50% of the equity shares or the ordinary shares which are issued by the other entity, which is now known as a joint arrangement. For instance, if now another company to acquire a joint control over this company here, assuming our company here is A Limited. So joint control means that parent company acquires 50% of the equity shares or the ordinary shares issued by this company, whereas the other entity acquires something called what? Acquire 50% of the remaining shares. So it basically means that the operating and financial decisions now of this particular company will be jointly made by the parent company and these other entities. So therefore, it is important to note that when we talk about a joint arrangement, formerly known as a joint venture, this whereby the parent company has acquired 50% of the shares, the remaining 50% of the shares are acquired by the other entity. So this company here, we refer to it as a joint arrangement. Previously, we used to refer to this as what? As a joint venture. And therefore, here we have two types of joint arrangement. I think there is seen this particular question somewhere, which was asking about types of joint arrangement. So we have two types. One, joint venture. So joint venture currently is a type of a joint arrangement. And number two, we have something called a joint operations. A joint what? Operations. So those are the two types of what we refer as what? Joint arrangement. Now, having known what is an associate, what is known as a joint venture, or what is a joint arrangement, then we need to proceed and discuss how do we prepare group accounts whenever the parent company has invested in an associate or has invested in a joint arrangement. So according to this particular standard here, that is International Accounting Standard number 28, whenever the parent company has invested in an associate or has invested in a joint arrangement, then the group accounts are prepared using a certain method, which is known as what? Which is known as equity method. So in other terms, we can say that investment in associate and joint arrangement, investment in associate and joint arrangement are accounted for using equity method. Are accounted for using equity method. Equity method are accounted for using equity method. So how do we apply this particular method here? And first of all, it's important to note that this particular method here, that is equity method, this method is basically governed by the International Accounting Standard number 28. International Accounting Standard number 28. Now, how do we apply this equity method? Specifically, in preparation of a consolidated statement of profit or loss, consolidated statement of profit or loss, and other comprehensive incomes. So how do we apply this particular method? So one, similar items of revenue and expenses, those of the parent company and those of the associate, or basically those of the joint arrangement, are not combined. They are not combined, or in other terms, they are not added together. They are not added together. So meaning that if, for example, maybe you come across a question and you're told, for example, you're told that maybe you're given a question, the parent company which has acquired a subsidiary, and also this company has acquired an associate. And what you're required to do here, you're required to prepare the consolidated statement of profit or loss. So what we do here is that we take the revenue and expenses. We will take the revenue and expenses, that of the parent plus that of the subsidiary, that of the parent and that of the subsidiary. So in this case, we are saying we don't include the revenue and expenses, that of the associate here. So the revenue and expenses of the associate is not supposed to be included in the consolidated income statement, and that is in accordance with the equity method. That is in accordance with the equity method. Instead, what we include in the consolidated statement of profit or loss, as far as the associates, as far as the joint arrangement is concerned, is something called the group share. Let's just refer to it as let's just refer to it as the group share. The group share of associate, or basically joint arrangement, a profit after tax. So the group share of associate or joint arrangement profit after tax is computed and recognized. Is computed and recognized as part of other incomes. As part of other incomes. As part of other incomes. Other incomes within the consolidated statement of profit or loss. So basically what that means is that if, for example, this company had maybe acquired 40% of the shares issued by the associate, and this associate here maybe had a profit after tax of something like 10 million. So what we do, we compute the parent company share of this particular profit here. The parent company share of this profit would be equal to the profit reported by the associate, which is 10 million, times the parent company shareholding in associate, which is 40%. So this one will give us 4 million. Now, this 4 million is the only item we include in the consolidated income statement as far as the associate or as far as the joint arrangement is concerned. And we are saying that this one will be recognized within the consolidated income statement as part of other incomes. As part of other income. So therefore, what is important here to note is that as far as the associate or even the joint arrangement is concerned, we don't combine its revenue and expenses with that of the parent. We don't combine its revenue and expenses with that of who? Of the parent. What we only combine here is the revenue and expenses of the parent, that of the subsidiary. That's what we know. But as far as the associate, the joint arrangement is concerned, we only compute something called the parent company share of the associate profit after tax, of the joint arrangement profit after tax. We recognize that as an income, as part of other incomes within the consolidated income statement. Even now, before we look on how to apply, to see how we apply this method in preparation of consolidated statement of financial position, it is important to note that in terms of how we account for associate, in terms of how we account for the joint arrangement, we account for them in the same way. So if we are told the parent company had acquired an associate, had acquired a joint arrangement, the treatment of that during the preparation of the group account is the same. Is what? Is the same. Then next I want us to look on how do we apply these particular methods here, specifically in preparation of a consolidated statement of financial position. Preparation of a consolidated statement of financial position. Now, equally here, similar items of assets and liabilities. Assets and liabilities, those of the parent company and those of the associate and those of the joint arrangement here are not combined. They are not combined. In other terms, they are not added together. They are not added together like what we were doing when preparing the group account specifically, whereby the parent company has invested in a subsidiary. So meaning that if you come across a question and you're told the parent company has invested in a subsidiary, has invested in associate or basically a joint arrangement, and you are required to prepare this one, consolidated statement of financial position, what you are saying is that you are supposed to add similar items of assets and liabilities, those of the parent and those of who? Of the subsidiary. In this case, we don't consolidate an associate, we don't consolidate a joint arrangement. In other terms, what that means here is that we don't add the assets and liabilities of the associate or those of the joint arrangement together with those of who? Of the parent. Together with those of the parent, like what we do in case of a subsidiary. So we know that whenever the parent company has invested in a subsidiary, we combine, we add together similar items of assets and liabilities, those of the parent and those of the subsidiary. We don't do that when it comes to an associate, when it comes to what? To joint arrangement. Instead, what do we include here in the consolidated statement of financial position as far as the associate or joint arrangement is concerned? So what we include here is something called investment in associate, or basically investment in joint arrangement. Investment in associate or joint arrangement is computed and recognized as a non-current asset, in the consolidated statement of financial position, So how do we compute this one? Investment in associate, or basically investment in joint arrangement. So here, we first of all start with the cost of investment. When talk about the cost of investment here, we're referring to the purchase consideration which was paid by the parent company in acquiring the shares of the associate, in acquiring the shares of the joint arrangement. So in other terms, this is the purchase consideration. How much purchase consideration did the parent company pay in acquiring shares of the associate, in acquiring shares of the joint arrangement? And then to this, what do we add? We add the group share of the associate, or basically joint arrangement, post-acquisition retained earnings. Post-acquisition retained earnings. So when talk about the post-acquisition retained earnings of the associate or the joint arrangement, we are talking of the retained earnings of associate or joint arrangement after it was acquired by the parent. After it was acquired by the parent company. So compute that one, compute the post-acquisition retained earnings of associate or that of the joint arrangement. You multiply that with the parent company shareholding in that particular associate, or basically in that particular joint arrangement. So that's basically the one of the items, or basically what we add to this. And then to this, finally, we less something called the impairment loss. Now, when talk about the impairment loss here, this is basically the decrease in value in the investment made in an associate, Now, in this case, you can be told the amount invested, or basically the investment in associate, in the investment in joint arrangement, has lost that certain value. Usually that may happen because maybe the associate has been making losses, or maybe the associate has not been performing that very well, and therefore the investment made in that associate, the investment made in that joint arrangement automatically has lost some value. If, for example, the parent company had invested like 20 million in the associate, and maybe because the associate has not been performing that well, so in this case, the amount invested or that investment will have lost some value, because maybe the market price or the shares, or the price at which the shares of the associate or the shares of the joint arrangement are trading in the securities exchange market, that price has reduced because the associate or the joint arrangement has been making what? Losses. So in case there is such an impairment loss, this is something you'll be told, and also the examiner will give you the amount of impairment loss. Come and less it here. And then whatever you get here is what is known as investment in associate, investment in joint arrangement. We are saying that this is the only item we recognize in the consolidated statement of financial position as far as the associate or joint arrangement is concerned. We are saying we don't include the asset, we don't include the liabilities, we don't include the equity of the associate in the consolidated balance sheet, and also that applies to the joint arrangement, because you have said in terms of how we account for joint arrangement, in terms of how we account for the associate, we account for them in the same way, way. So therefore, this basically what you need to know as far as the investment in associate, investment in joint arrangement is concerned. We prepare the group accounts in accordance with the IAS 28, which requires that we prepare the group accounts using equity method. One, when preparing the consolidated income statement, don't combine the revenue and expenses of the parent. with those of the associate or those of the joint arrangement. Instead, compute the parent company share of the associate profit after tax, recognize it as part of other incomes within the consolidated statement of profit or loss. When preparing the consolidated statement of financial position, don't consolidate asset and liabilities, those of the associate, those of the joint arrangement with those of the parent. Instead, compute something called the investment in associate, investment in joint arrangement, and this is the only item you recognize within the consolidated statement of financial position as an item of what? Non-current asset. I think with that particular knowledge here, we can proceed and look on a question now. And most of the questions nowadays, you'll actually be given a question with 3 companies: parent company, subsidiary, and also what? Associate. So, and then what you're required to do is basically to prepare the group account. So you have to remember that when preparing the group account, similar items of asset, liabilities, revenue, and expenses, those of the parents, those of the subsidiary should be combined, but we don't combine items of asset, liabilities, revenue, and expenses, those of the associate, or those of the joint arrangement with those of what? Of the parent company, with those of the parent company. Okay, so we basically have a number of questions from the past papers. So I want us to start with this one. This one, for which sitting is this? Which sitting is this? Let's start with this one for we have basically a number of them, number of questions. So let's start with this one for April 2022, question number 4B. April. April 2022, question 4B. For B. Question 4B. Yes, are you there? If we are there, we can you can confirm. We go through the question. Are you there? Are you there? Are you there? Yes, are you there? Are you there? Yes or no? Are you there? Are you there? Confirm whether you have the question with you. Okay. So the question reads 4B, it reads on 1st of April 2021, 𝗔𝗙 Limited acquired 75% of the equity shares of Salama Limited when the retained earnings of Salama Limited stood at shillings 234,000. The acquisition consideration consisted of a cash amounting to 510 million and share exchange on the basis of 2 ordinary shares of 𝗔𝗙 Limited for every 3 ordinary shares acquired in Salama. So the market value of 𝗔𝗙 Limited shares as at 1st of April 2021 was shilling 16 per share, and then your total accounting entries have been made in respect of the share exchange transaction. And then you're told the draft statement of financial position of the 2 companies as at 31st of March 2022 were as presented below. So we have the non-current asset, current asset. Down there we have equity and then non-current and current liabilities. We have some additional information, number 1 up to note number 5. What are we required to do? Part A, determine the value of investment in Amua Limited. Part Roman 2, calculate the value of goodwill arising on acquisition of Salama. Roman 3, prepare the consolidated statement of financial position of 𝗔𝗙 Group as at 31st of March 2022. So what we say is that once you come across such a question for group accounts, the first thing always you do is to come up with a group structure. So that's the first thing we need to have here. We need to come up with the group structure. So where do we have the information about this? The information about the group structure. So if you go back to paragraph 1 of this particular question, in paragraph 1, you're told that on 1st of April 2021, 𝗔𝗙𝗐 Limited acquired 75% of the equity shares of 𝗙𝗏 Limited. Even before we move now to the other information, we are told this company, which is called 𝗔𝗙𝗐 Limited, acquired what? Acquired 75% of the equity shares of the company, which is called 𝗙𝗏 Limited, and the acquisition took place on 1st of April 2021. So basically what that means is that this will be the parent, whereas this will be what? Will be the subsidiary. Now, equally, in the additional information, can we go to the additional information down there? Specifically, we go to the additional information number 4. In additional information number 4, we are told on 1st of April 2021, the same date, 𝗔𝗙𝗐 Limited also acquired 30% equity interest in a company which is called 𝗪𝗧 for sh65 million cash. So this company here, that is 𝗔𝗙𝗐 Limited, on the same date, 1st of April 2021, we are told it acquired 30% equity interest. 30% equity interest in a company which is called 𝗪𝗧 Limited. So what that means is that 𝗪𝗧 Limited here will be an associate. Because you have said once the parent company acquire ordinary shares or equity shares, which lies between 20% to 49%, then that company is known as an associate. And actually, in this case, the parent company is regarded to have acquired significant influence in that particular company here. So therefore, here we have 3 companies. We have 𝗔𝗙𝗐, which is the parent, 𝗙𝗏, which is the subsidiary, and then 𝗪𝗧 Limited is what? Is the associate. You can see specifically when they were acquired on 1st of April 2021. And we say it is also important for you to be able to do what? To determine when are you required to prepare the group accounts, so that you can determine, was there a subsidiary which was acquired, or was there any company which was acquired during the current year? If you go to the requirements, specifically Roman 3, we're required to prepare the group accounts for the year which ended 31st of March 2022. So the next financial year of this company will start on 1st of April, meaning this year started 1st of April 2021. And actually, you can see that is the date both 𝗙𝗏 and 𝗪𝗧 were acquired. This is the date they were acquired, both of them. They were acquired exactly at the start of the year, and actually that is the date of what? Of consolidation. The date of what? Consolidation. So meaning that if, for example, in this case, we are required to prepare the consolidated statement of profit or loss, which you're not required to prepare, then definitely in this case, in preparing consolidated statement of profit or loss, in this case, we would have taken the revenue of the parent plus that of the subsidiary, and actually for the subsidiary we take for the whole year, for the full year, because it was acquired exactly at the start. And then for the expenses, we do the same for the parent plus also the subsidiary. In this case, we have said we don't include the revenue and expenses of who? Of the associate here. We don't combine the revenue and expenses of the associate with those of the parent. So instead, as far as this associate is concerned, we need to compute the parent company share of the associate profit after tax, and we recognize it here as part of the income. So what are we required to prepare in our case? Consolidated statement of financial position. And here we are going to combine, we are going to add together similar items of assets and liabilities, those of the parent and those of the subsidiary. And in fact, that's what you can see in this particular question here. If you check on the information we have at the paragraph 1, you'll only be able to see that you see that we're only given the balance sheet of the parent, that of the subsidiary. In other terms, you're given assets and liabilities of the parent and those of the subsidiary, because in this case we are saying in preparing what is required in Roman 3, we don't need to be given the assets and liabilities, or we don't include the assets and liabilities of the associate, that is 𝗪𝗧. That's why you are not given the asset, or you're not given the balance sheet of 𝗪𝗧. Now, before we answer our question, as required in Roman 1 and also Roman 2, what we need to do, we need to go through the addition information. We see, are there some other workings which are required? So let's do that. We go to the addition information number 1 now. And what are we told here? We are told the fair value of Salama Limited net asset approximated their carrying amount with an exception of a specialized piece of equipment which had a fair value of 120 million in excess of its carrying amount. This equipment had 10 years remaining useful life on 1st of April 2021. So recall, this is something I mentioned in our previous class. I insisted on this. This is something you'll come across in all questions for group account. We said whenever this company is being acquired, the subsidiary is being acquired, the subsidiary company revalue its asset in readiness of acquisition. But once it has revalued the asset, the subsidiary company do not account for valuation. As a result of that, we make two key consolidation adjustments. One, we make adjustment for evaluation gain. Number two, we also have to compute depreciation other charge. Yes, so therefore, that we need to do some working for that. So which is now a fair value exercise. A fair value exercise by who? By Salama Limited. A fair value exercise by Salama Limited. So one, we need to determine the revaluation gain, because in our case, we are told this item of specialist piece of equipment had a fair value, or its fair value was in excess. In other terms, this was in excess or was more than the carrying amount. Remember, the carrying amount is the same with the book value, is the same with the net book value. This one was, the fair value was more than this, with an amount of 120 million. Now, if you check on the figures we have in the balance sheet or in the statement of financial position under paragraph 1, our figures are given in thousands of shillings. In thousands of shillings. So you have to be consistent by working with all our figures in thousands of shillings, omitting the last 3 zeros. So because you can see that figure is in million, we use that figure, we work with that figure in thousands of shillings, we omit the last 3 zeros. So now this one is basically a revaluation gain because the fair value exceeded this. But now this revaluation gain was not accounted for. If you can be able to remember what we did in the other question, we said this one, in preparing our consolidated statement of financial position, we added to the PP, we added to the group PP. Number two, this particular 120,000 is a revaluation reserve of the subsidiary, but because it is a revaluation reserve which occurred on the date the subsidiary company was acquired, then we treat it as a pre-acquisition revaluation reserve, and therefore we are going to use it in computation of goodwill. In computation of what? Goodwill. Those are basically the adjustment in relation to that. Number two, we need to compute depreciation other charge. So what you need to remember here is the formula. And we said we take the revaluation gain divided that with the remaining useful life. Revaluation gain divided that with the remaining useful life, and then we multiply that with the proportion of time. We multiply that with the proportion of what? Of time. The proportion of time is the time difference between the date of acquisition and the date of consolidation. So the revaluation gain here is this one, which you have computed, which you already have there up there, 120. So if you go back to note number 1, what is the remaining useful life of this asset? As per the information given in note 1. Remaining useful life of the asset that is given in note 1. Can I get the answers here? I see whether we are together. Remaining useful life as per the information you have in note number 1. Remaining useful life as per the information you have in note number 1. Remaining useful life as per the information you have in note number 1. I'm waiting for the answers here from Akina Samuel, Akina Damaris. Remaining useful life as per the information you have in note number 1. Samuel Damaris, are we together? Okay, so let's continue. So we have 10 years. We have 10 years. So we divide this with 10, and then we multiply that with the proportion of time. The proportion of time is the time difference between the date of acquisition and the date of consolidation. Remember, we have said that this particular company here was acquired on 1st of April 2021. And actually, we have said it is exactly at the start of the year. So from the start of the year, that is on 1st of April 2021, to the end of the year, this is the date of acquisition. Then the date of consolidation is the date we are required to prepare the group accounts. That is 31st of March 2022. And actually here we have said we have 1 year. So therefore we compute the depreciation under charge for 1 year, So this will give us what? 120 divided by 10 times 1. So this will give us what? This will give us 12,000. Is it 12,000? Yes, 12,000. Now this 12,000, this one should be deducted from the group PP in preparing our consolidated balance sheet. And then the other key consolidation adjustment, remember we said in an exam setup, there are those items which we said you don't need to compute. And actually we said moving forward, we will not be computing them because even in an exam, we not compute them. One of it is the retained earnings. So therefore, the key consolidation adjustments as far as this is concerned, the key items which are adjusted, we less it from the PP. And in case you are preparing the consolidated income statement, you add it to the cost of sales. So are we preparing the consolidated income statement? No. So the key item to be adjusted is we less it from the PP. That is the key item. So we are done with that point there. Let's move to the additional information number 2. In the additional information number 2, we are told it is a group policy to value the non-controlling interest at the fair value at the date of acquisition. The fair value of the non-controlling interest in Salama Limited on 1st of April 2021 was estimated at 144 million. So we said, if you come across that information, that is the policy of the group to measure NCI at fair value, it basically means that in computing the goodwill, you use the full goodwill method. And equally, that's what you can see, the examiner has given us the fair value at NCI, the NCI at fair value. So that information now, we are going to use it in answering Roman 2, because in Roman 2, you can see you are required to compute the goodwill on acquisition of who? Salama Limited share. We are going to use that information in Roman 2. And then let's move to Roman 3, where we are told, during the year which ended 31st of March 2022, Salama Limited, which now is the subsidiary, sold goods to 𝗔𝗙, which is the parent, for shilling 64 million, earning a gross profit margin of 25% on the sales. Now, what is that? That is what you have as amount of intra-group trading, or basically intra-group what? Sales. Sales between the parent and the subsidiary. How much is that? How much is the amount there? The amount there is 64 million, but in thousand of shillings will be 64,000. Which adjustments are required as far as this is concerned? One, we less this from the group revenue, and also we less it from the group cost of sales, from the group cost of sales. And then you're told in the last sentence of note number, the last sentence of that last sentence, we are told 𝗔𝗙 Limited still held shillings 48 million worth of these goods in the inventory at the end of the year. So remember what you said here is that, or basically what you're told in the first paragraph of note 3, is that Salama Limited sold some goods to 𝗔𝗙. Remember we said that this company which sold the goods automatically made the profit. But we say this profit will be realized only when all the goods which were sold to this company will be sold to third parties. And therefore, he said if some of the goods were not yet sold at the end of the year, then we said we have to compute something called the unreleased profit on inventory. Unreleased profit on inventory. And this unreleased profit on inventory is by the selling company. The selling company here is Salama Limited. It is Salama Limited which sold goods to 𝗔𝗙. How do we compute this one? You have to recall the formula. We take the unsold goods times the gross profit margin. So the unsold goods, we are told they had a value of 48 million. And then we also given the gross profit margin, which is 25%. 25%. So this is now like a quarter, which will give us what here? A quarter, is it 12? Will that be 12,000? 12,000? Yes, 12,000. Now, which are the key two items adjusted with this one? This one we list it from the group inventory. Once we add the inventory of the parent plus that of the subsidiary, we list 12. Number two, if we were required to prepare the consolidated income statement, consolidated statement of profit or loss, this one we added to the group cost of sales. Are we required to prepare the consolidated income statement? No. So therefore, this adjustment is not required. So therefore, the key item to be adjusted here is to less that from what is known as the group what? The group inventory, the group inventory. So I think we are done with that particular point, but we still have the last paragraph of note number 3, where we are told that Salama Limited still had the full invoice of shilling 64 million in its trade receivables at 31st of March 2022. However, 𝗔𝗙𝐿 Limited trade payables only showed shilling 34 million, as it had made a payment of 30 million on 31st of March 2022. Now, that is information which you're given here is basically information about something called the amount of intercompany debts. So whatever you're given here, there in that last paragraph of note 3 is about the amount of intercompany debt, which is also known as amount of intercompany owings. So remember here, Salama Limited, that basically what we are told in paragraph 1 of note 3, Salama Limited sold some goods to 𝗔𝗙𝗐. So what that means, therefore, is that when this company sold the goods to 𝗔𝗙𝗐, that's generally what happened. If I sell goods to you, I will sell those goods with something called an invoice, formally requesting you to pay for the goods. That's why we are told this company here, 𝗔𝗙𝗐 Limited, because the goods which were sold to 𝗔𝗙𝗐, they had a value of 64. That's what you have to remember here, 64 million. So those goods were accompanied with an invoice. So what was the role of that invoice? It was to formally request this company to pay this amount of 64. So this company, we are told, okay, what are we told here? We are told that Salama Limited had the full invoice of 64. This company had the full invoice of 64 million. So in other terms, even before we proceed to analyze that information, what this means is that because this company sold goods worth 64 million to 𝗔𝗙𝗐, it is obvious that the the subsidiary here was expecting to receive 64 million from the parent. So this amount of money, which the subsidiary was expecting to be paid, to receive from the parent, in the books of account of the subsidiary, this one was recorded as trade receivables. This one was recorded as trade what? Receivables in the books of account of this. But now in the books of account of the parent, that was the part of the trade payables, because the parent company was expecting to pay 64. That is the first thing you need to understand. In the books of account of the subsidiary, it was a receivable. In the books of account of the parent, it was what? It was a payable. Now, what we are told in the last paragraph of note 3, I want us to check that again. We are told Salama Limited had the full invoice of 64. This company had a full invoice of 64. So the amount now which was included in the trade receivables of Salama Limited was 64 million. 64 million as at 31st of March 2022. However, 𝗔𝗙𝗐 Limited trade payables, the trade payables of 𝗔𝗙𝗐 Limited, only showed 34 million. So the amount included in the payables of 𝗔𝗙𝗐 was 34. So as per the books of account of 𝗔𝗙𝗐 at the end of the day, it showed that it owed the parent company sorry, it owed the subsidiary company 34 million, as it had made a payment of 30 million. So meaning that this company had made a payment of 30 million. And in this case, we are told the amount of money which the subsidiary was still expecting to receive from the parent was 64. It basically means that this payment which was made by 𝗔𝗙𝐿 was yet to be received by who? This payment which was made by 𝗔𝗙𝐿 was not yet received by Sarama. And therefore, if you can be able to recall, we refer to this as the amount of cash in what? The cash in transit. This is the amount of cash in what? In transit. The amount of cash in what? Transit. So therefore, this is basically an amount of intercompany debt which is not the same. And therefore, this particular amount here, this one we will deduct it from the group receivables. Once we have added the receivables of the parent, those of the subsidiary we less 64. This one we will less it from the group payables. And this one we added to the group bank and cash balance. Group and cash balance, group cash and bank balance. So that is basically the adjustment which is required in case or whenever you have amount of intercompany debt, basically which is not the same. So I think we are done with that one. Let's move to point number 4. And point number 4, we are told that on 1st of April 2021, that is now exactly at the start of the year, 𝗔𝗙 Limited had acquired 30% equity interest in 𝗔𝗔 Limited. I think we were able to go through that point when coming up with a group structure, and for sharing 65 million in cash. And then you're told 𝗔𝗔 Limited sustained heavy losses over the last few years, and 𝗔𝗙 Limited hoped it would turn it around through significant influence over 𝗔𝗔. And then you're told in the year which ended 31st of March 2022, 𝗔𝗔 Limited made a loss of 150. So this is basically the loss now which was made by 𝗔𝗔 in course of the year. So we're going to use that in answering Roman 1 of our question here. And then question 5, no working which is required here in relation to note 4. In note 5, we are told impairment test performed on 31st of March 2022, that is at the end of the current year, revealed that the investment in 𝗔𝗔 had been impaired by 5 million due to sustained trading losses. However, no impairment was required in respect of the goodwill arising on acquisition of what? Sarama. The goodwill on acquisition of Sarama had not impaired. So no working equally which is required there. And I think we can go straight to answering our question here. We start with part A, whereby we are required to determine what? To determine the value of investment in 𝗔𝗔 Limited. Remember, in this case, 𝗔𝗔 Limited is the associate. As at 31st of March 2022. In other terms, what the examiner was requiring you compute here is something we have referred to as investment in associate. So the only item which you recognize in the consolidated balance sheet or the consolidated statement of financial position as far as the associate is concerned. So here we just need to have a single column. And I hope you can remember our figures. All our figures would be in thousands of shillings. So I've given you the format for computing this one. So first of all, we have said we start with the cost of investment. The cost of investment, which is also known as the purchase consideration. Purchase consideration. That one, purchase consideration, is in note number 4. When the parent company acquired 30% shareholding in 𝗔𝗔, that was acquired at how much cost or at which cost? That information, we have it in note number 4. In note number 4, you're told on 1st of April 2022, 𝗔𝗙 Limited also acquired 30% equity interest in 𝗔𝗔 for how much? For 65 million. For 65 million. 65 million in cash. That is the cost of investment or the purchase consideration. Then to this, I've said we add the group share of post. That is the group share of associate post acquisition retained earnings. Post-acquisition retained what? Earnings. But now, if you can also recall what you're told in note number 4, the last sentence, we are told after this company was acquired, after 𝗲𝗏 Limited was acquired, because 𝗲𝗏 Limited, remember, it was acquired exactly at the start of the year. So after it was acquired, in the last sentence of note number 4, we are told, in the year which ended 31st of March 2022, 𝗲𝗏 Limited made the losses. So, and actually this loss now, which was made during the current year by 𝗲𝗏 Limited, remember, 𝗲𝗏 was acquired exactly here. This is the date it was acquired. So this particular loss it made during the current year, we say it is a post-acquisition loss. Is a post-acquisition what? Loss. Our company didn't make a profit. It made what? A loss. And because we have a loss here now, what we do, we come and change this. We will not add, because it's a loss, we say less. Less the group share of the associate post-acquisition losses. So not not profit, but to what? Losses. So that loss, we less it. We'll compute the group share of this loss of 150 million, and then we less it here. But if it was a profit, we do what? We add it there. Are we together? Yes. So therefore, you're going to take 150, but in thousands of shillings, times the parent company share of this, or the group share of this. So the group share of this will be equivalent to 30%. 30%. So this will give us what? 45,000. And because it's a loss, we are saying we less. But if it was a profit, we do what? We add. And then finally, I've said to this, we less impairment loss. And I think we are given some impairment loss in relation to investment in 𝗲𝗏. That is in note number 5. Impairment tests performed at the end of the year revealed that investment in 𝗲𝗏 had been impaired by 5 million. So this investment in 𝗲𝗏 had impaired by 5 million. So we have an impairment loss of 5 million. So we have 65 minus what? Minus 50,000, which will give us 15. So this is what is known as investment in 𝗲𝗏, investment in associate. This is the value you're going to recognize in the consolidated balance sheet as far as our associate is concerned. That basically what was required in Roman 1 of that question. The marks are located here. You can see they were 3. So let's move to Roman 2. Roman 2, where we are required to compute the goodwill. The goodwill on acquisition of who? The goodwill on acquisition of Salama here. Goodwill on acquisition of Salama Limited. And remember what you have said is that as per the information we have in note number, 2, we are going to use the full goodwill method. So here we are using the full goodwill method. That is the method we are going to use as per the information we have in note number 2. Yes, so here we need to have 2 columns, and our figures are in million, in thousand of shillings. So now under the full goodwill method, always here what we start with the purchase consideration paid by the parent company. Purchase consideration paid by the parent company. Now this purchase consideration paid by the parent company, we have that information in paragraph 1. Can we go back to paragraph 1 of our question? In paragraph 1, specifically sentence number 2, we are told the acquisition consideration consisted of cash of shillings 510 million and a share exchange on the basis of 2 shares for every 3 shares which were acquired in Salama. Now, this purchase consideration which was paid by the parent company, basically it was in 2 forms. It was in 2 forms. The purchase consideration which was paid by the parent company was in 2 forms. One, there was a cash consideration. There was a cash consideration which you are told was a 510 million. In thousand of shillings, it would be 510,000. and still there was a share exchange consideration. There was a share exchange consideration. If you can be able to recall, I think that is something we did in relation to this. Who can be able to remember? We computed this purchase consideration, I think, in our first class in this topic for group accounts. We computed that purchase consideration, which was paid by the share exchange consideration, which was paid by our parent. Who can be able to remember that figure? Or do we compute it afresh? The share exchange consideration. The share exchange consideration. Who can be able to see that figure? We computed it somewhere. Okay, so if you can't see it, let's just do it again. Let's do it afresh. Yes, it was no, this is not this one. Is it that figure 28,800? I think you're confusing maybe with another question. Okay, let's do it afresh here. So we said to compute the share exchange consideration one, we have to determine the number of shares issued by the parent company. The shares issued by who? The parent company. And then what do? We multiply those particular shares with their fair value. We multiply those shares with their fair value on the date of acquisition. So if we go back to the first paragraph, I think the first paragraph, the second sentence from last, we are given this one. We are given the market value or the fair value of the parent company shares on the date of acquisition. So we are told in the last paragraph, the second sentence from last, the market value of 𝗔𝗙 Limited shares on 1st April 2021, which is the date of acquisition. This one was 16. This one, remember, is already given. We already given that one. So what we need to do is to compute this one. So we're going to compute this using the information we have in paragraph, in sentence 2 of paragraph 1. Sentence 2 of paragraph 1, we are told the acquisition consideration consisted of cash of 510 and a share exchange consideration on the basis of 2 ordinary shares for every 3 shares which were acquired. So meaning that the parent company here, that is 𝗔𝗙, was to do what? Was to issue 2 shares for every 3 shares which were acquired. It was to issue 2 shares for every 3 shares which were acquired. So what we need to do here is to compute how many shares did the parent company acquire in 𝗔𝗙. The first thing we need to determine are the shares issued by this. Shares issued by our subsidiary. Where do we get that information? We get it from the balance sheet. From the balance sheet, specifically in the equity section, the balance sheet of the statement of financial position of Sarama at the equity, the ordinary share capital of Sarama, the equity share capital of Sarama is 300,000. What is the par value per share? The par value per share is 10. Par value per share is what? Is 10. So we divide the 2. So this means that the shares issued by this company here, they are 30,000. These are the shares issued by that company. So what are we interested with here? The shares acquired. The shares which were acquired were not 30, but the parent company acquired 75% of this. So 75% of 30,000. And this will give us what? 75% of 30,000 shares. Yes, so this will give us 22,500. So we have 2 times 22,500 divided by 3. And this, I think, was giving us what? 15,000 shares. 15,000 shares. So these are the shares now which were issued by the parent company to pay the purchase consideration. So therefore, to compute this share exchange consideration, we take this one, shares issued by the parent, 15,000 shares times the fair value, which is 16. And I think this is the one which was giving us what? Shillings 240,000. So that is the value of the share exchange consideration. Yes, so therefore the purchase consideration paid by the parent company was in those 2 forms, the cash consideration, the share exchange. Now, after considering the purchase consideration paid by the parent, because you're using the full goodwill method, we say to this, then we come and we add the NCI at fair value, the NCI at fair value, and this is given in note number 2, additional information number 2. That's why we are given the NCI at fair value. The NCI at fair value as per note number 2, which you're told was estimated to be 144 million. 144 million. So let's first of all, we add all this before we list now the net asset acquired. So what will be the total here? The total here will be what? Will be 9. Huh? Will be 8. $894. Now to this, what do we need to do? To this, we less the fair value of the net assets which were acquired. We less fair value of net assets, fair value of net assets acquired. Fair value of net assets acquired. Recall we said that in computing this one, or basically what we need to do first of all is to compute the net asset of the subsidiary on the date it was acquired. To compute the net asset of the subsidiary company on the date it was acquired, we said what we do is that we take the subsidiary company ordinary share capital plus the pre-acquisition reserves, plus the reserves the subsidiary company was having on the date of acquisition. So always we start with the ordinary share capital of the subsidiary, which is 300,000. Now, I'm getting that from the equity section in the statement of financial position of Sarama. There, 300,000. Remember also here, we say, if, for example, you're given share premium, in the statement of financial position of Sarama, if you're given share premium, we also said we include that share as a pre-acquisition reserve. Do we have a share premium? No. What about the retained earnings? The retained earnings, which we include here, we don't include or we don't take into account the retained earnings in the balance sheet, in the statement of financial position. No, because this one is at the end of the year. We said we take the retained earnings on the date of acquisition. On the date of acquisition. So the only, and actually we said this always will be given, you'll be given this figure, but if a subsidiary was acquired during the current year, like the other question we did for 𝗙𝗏&𝗔, where 𝗙𝗏 was acquired during the current year, we were not given the retained earnings on the date of acquisition. I showed you how to compute the same. But if a subsidiary is acquired before, maybe at the start of the current year, before the start of the current year, always will be given its retained earnings. In fact, if you go back to the information you have in paragraph 1, the first sentence, we are told when on 1st of April 2021, 𝗔𝗙 Limited acquired 75% of the equity interest in Sarama, when the retained earnings of Sarama stood at what? 234. That is the retained earnings of Sarama at the date of acquisition. That is now what we refer as pre-acquisition retained earnings. That's basically what we use here. Then we said the other item we also need to check here is whether on the date of acquisition, the subsidiary company revalued the assets and was there a revaluation gain? Yes. In our case, our subsidiary company, as per note number 1, revalued an asset, and there was a revaluation gain of what? Of 120. This revaluation gain, recall we said, is a reserve, but it is specifically a pre-acquisition. We use it in the computation of goodwill here. Goodwill fair. So those are basically the items you're going to or basically this is how we compute the what? We compute the subsidiary company or the fair value of the subsidiary company net asset at the date of acquisition. So which will give us 654,000. And because we are using the full goodwill method, here we take 100% of that, because we're interested with the net asset acquired by the parent and the NCA. But if you are using the partial goodwill method, we would have taken 75% of that. So 100% of this is 654,000. We less it from what we have here, and the difference now will be the goodwill on acquisition. Goodwill on acquisition, which I'm told is what? Is 240. And then here we check, is this goodwill impaired? As per the information we have in note number 5, we are told in sentence number 2, actually in the last sentence of note 5, we are told, however, no impairment loss is required in respect of the goodwill arising on acquisition of Salama. This goodwill was not impaired. And therefore, record, we say that this one will be recognized as a non-current asset in the consolidated statement of financial position. We recognize it as a non-current asset there. So I think that basically what is required here. In Roman 2, the marks allocated here were 3. These are the items which will earn you the 3 marks. So those are the items generally which are marked, which earn you the 3 marks. Cash consideration, share exchange, fair value at NCI. You can see most of the items here are free because what we have only computed is one item. This was given, this was given, this given, this given, this is also given, given. So basically, that is it. So let's move to the last part, where we are required to prepare the consolidated statement of financial position as at 31st of March 2022. 31st of March 2022. And actually, the preparation of this is also very, very simple. Take into account, we know maybe the necessary consolidation adjustment, and already we have the group structure. Now recall what I've said is that here we have 3 companies. We have the parent, we have the subsidiary, we have what? Associate. So what we do in preparing this, we only add assets and liabilities, those of the parent, those of the subsidiary. So in this case, we don't include the assets and liabilities of the associate here. And that's why you can see even in this particular question, the examiner has not given us the assets and liabilities of which company? Amua. We are not given the statement of financial position for Amua. So what we include here as far as the associate is concerned is this figure which you have computed here, this one, investment in associate. Sasa, in other terms, we say we don't consolidate an associate. We only consolidate a parent and who? And the subsidiary. So having known that, then the preparation of this becomes very, very simple. So what we do, we start with an non-current asset here. For the non-current asset, we are going to start with the property, plant, and equipment. We take the property, plant, and equipment of the parent, 1595, 300 plus 636, 400. And then we check, do we have any adjustment affecting PP? Yes. So there was this revaluation of assets. We have this 120, which we said we add to the PP. And then we have depreciation at the charge of 12, which we said we less from the PP. So to the PP, we are going to add 120. And at the same time, we less 12,000. That is the adjustment. We don't have any other adjustments there. So let's get the final figure. The final figure. $23, 39,700. 23, 39,723. Yes. So that is it. Below that, what do we have? Below that, we have investment. Investment. Now, for the investment, we take that of the parent 575 plus that of the subsidiary 0. But remember, in this case, what we said is that anytime you see being given in an investment in the balance sheet of the parent, this is a cash consideration which the parent company had paid in acquiring shares of the subsidiary, in acquiring the shares of the associate. For example, you know that when the parent company acquired shares of the associate, the parent company paid this amount, this cash consideration. That amount is included here. Do we include it in the consolidated statement of financial position? No, because we have used this particular amount, 65,000, in computation of this particular investment in associate. We don't include that 65,000 there. So we just it from this. Number 2, I've said we add 0 minus 65,000. Number 2, when the parent company acquired a 75% shareholding in Sarama, the parent company paid a cash consideration of 510. This 510 is also part of this. Do we include it in the consolidated statement of financial position? No, because you have used that in computation of goodwill. So if you take this minus 1, you'll see by the end of the day, it will give us what? 0. So any cost of investment in a subsidiary, in associate, we don't include it here. Then we don't have any other item of non-current asset, but in this case, we have to remember that this particular goodwill which you have computed here, the goodwill on acquisition of Sarama, goodwill on acquisition of Sarama, we recognize it here as a non-current asset, which is 240,000. Also, in relation to, as far as 𝗲𝗄 Limited is concerned, our associate, we have computed this investment in associate. We have said that this one, we recognize it here as a non-current assets, investment in associate. In associate, which is 15,000. So that is, in fact, the only item which we include there as far as the associate is concerned. We don't include its asset and liabilities here. Then let's proceed and record the current assets. So for the current asset, what do we have? We start with the inventory. Actually, we have 3 items. So for inventory, we take that of the parent, 165,000, plus that of the subsidiary, 160,000. And then in this case, there is an adjustment to be made to the inventory. We have this and this profit of 12, which we said we less here. We less 12,000. That's the only adjustment. We get the final figures. So this should be 325 minus 12. Minus 12, which will be 313,000. So below that, we have trade receivables. Trade receivables, we do the same. We take that of the parent, 247,100 plus 107,800. And then we have an adjustment to this. Yes, we have amount of intercompany debt, this one here. And we said the amount we are going to less from the group receivables is this one, 64. Is 64. So we less 64,000 here. 64,000. We get a final figure of what? We get a final figure of 90,900. So finally, here we have bank. Bank, we do the same. We take that of the parent, 21,000 plus 13,800. And then in this case, we say this cash in transit, this one, 30, we will add it to the group cash and bank balance. So to this, we add 30,000. So that will give us 51 plus this one, which will give us 64,800. Yes. So we say no need of basically, in fact, getting the totals there. No need of doing that because we say these are the items which will give you the marks here. These are the items now which the examiner or not will be marking. He will not be interested with your totals here. Yes, I think with that now we can proceed and record items of equity. We proceed record items of equity. Items of equity. So for equity, we're going to start with the ordinary share capital. So remember here we said for the ordinary share capital, we only include that of the parent company. For share capital, you don't combine that of the parent and that of the subsidiary. So for the parent is 850, but now this one will also be having some adjustment because if you can be able to recall, the parent company paid the part of the purchase consideration in acquisition of part of the purchase consideration on acquisition of subsidiary through share exchange. And if you go back to paragraph 1, the last sentence, we are told no accounting entries had been made in respect of the share exchange consideration. In other terms, the shares now which were issued by the parent company, they were not accounted for. And I think I can remember the shares which the parent company had issued were 15,000. 15,000. Is that the case? Yes. And actually have arrived at the purchase consideration by multiplying these shares with their fair value, which was giving us 240,000. Now, is that the amount which we add to the share capital? No. The amount which we add to the share capital here will be equal to the shares which were issued, 15,000. We multiply this with the par value per share. The par value per share is the value which we have in the balance sheet, in the statement of financial position and the equity. And the equity, the par value per share is what? Is 10. So the amount which we add to the share capital is based on the par value of 10 of 10. So this 150 plus this one, and that will give us what? That one will give us 1 million. So then below that, what do we have? Below that, we have retained earnings. But before you go to that, these shares equally which were issued, you can see they were issued at a premium because they were issued at a price of 16, the par value of 10. The amount which is above 10 is a share premium. So we include here, that here, because that is a share premium of the parent. So how much will be the share premium? The shares issued, 15,000 times the amount which is above that. The amount which is above 10 is 6 bob. So we multiply that with 6, which will give us what? Which will give us 90,000? Yes, 90,000. So below that, what do we have? We have the retained earnings. Now, for the retained earnings, we say this is one of the item which you don't have to compute. We say that one unaiacha hivyo. Unaiacha hivyo, you don't have to compute that one. And then in this case, we will get the total equity, which we can't be able to compute there. Then from there, there is also something we said should also be computed and included here, called the non-controlling what? Interest. We said the non-controlling interest is the amount of money invested by the minority shareholders in the subsidiary. Equally, we said that is also another item you don't have to compute. So then next we proceed and call liabilities. For the liabilities, we have what? 8% debentures, and because these are liabilities, we are going to add the liabilities of the parent with those of the subsidiary. So we have for 60,000 plus 40. So do we have any adjustment here? No. We get the total figure 500,000. And finally, we have current liabilities. Current liabilities, we have the trade payables. So for trade payables, we take the trade payables of the parent, which is 442,000. 442,000 plus 167,200. And then we have an amount of intercompany debt, which will be adjusted here. We say the amount we are going to less from the payables is 34. So to this, we less 34,000. 34,000. We get the final figure. The final figure here. The final figure I'm told by Gilbert is 575 to what? 200. And finally, what do we have? We have the current tax. So remember what we said, that once you come across a question for group accounts and you're given an item of tax, always you say these always a free mark. So we have 108,000 plus 52. The reason why this is a free mark is because any item for tax, be it in the income statement, be it in the statement of financial position, do not have any adjustment. So this is always a free mark. This will give us what? 16800. 16800, yes. That is it. That is it. So that by doing that question like that, you'll have gotten all the marks. You can see the marks which are located here are 8. So you can see we have how many entries? Correct. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So remember what we said is that mostly for this particular question for group account, for any correct entry which you have here, you get 2 marks. So meaning, like for this particular question, you just needed to get 4 items correct. 4 correct items. 4 correct items. So if you get 4 correct items, then you can see, then you'll have gotten now your 8 what? you are 8 marks there. You are 8 marks there. You are 8 what? You are 8 marks there. Yes. So that is it. That basically that what was required as far as that particular question there is what is concerned. That what was required there. Yes, and therefore that's basically how we consolidate an associate, or basically that's how we deal with an associate when preparing the group accounts, when preparing the group account. So there is a question I want to give you here as an assignment. You look on it. And then basically what you need to know now is that we are done with this particular topic. Now what is maybe remaining is for us to be able to do more questions here, more questions on a group account. And I think what I will do, we're going to do 2 questions in our next session. But basically because we don't have a lot of time, what I will do, I'll give you those 2 questions. You try to look on them on your own. Once we meet on in our next session, what I'll do, I'll basically show you how to handle these particular questions for group accounts in an exam setup, because we may not be having enough time to come back to this particular topic here. Because I think like now from next week, how many weeks will be remaining? I think from next week we will be having like 3 weeks, if I'm not wrong. 3 weeks means that we have 6 classes, and I think we are yet to do something to do with partnership, and also we need to go through the theory topics. So we don't have much which is remaining, but actually from tomorrow, it basically means that we have 1, 2, 3, 4, 5, 6. So basically we only have 6 classes which are remaining. So I'll give you this question here. You attempt it on your own. December 2022, which is question number 3. Question number 3. There is also another question from another question here. We also have another question here for, I think we have, is it December 2023? Yes, let me see. So if you have the past papers, can you check for me the question for April 2023? April 2023, you check for me a question here, which is there for group accounts. You check, is it a question for who? For Tutu, Sai, and Lifa? Can someone confirm for me? Oh, confirm for me whether that is a question. Sai, Lifa, and Tutu. Sai, Lifa, and Tutu. Sai, Lifa, and Tutu. Yes, so yes, that is the question I want you equally to attempt. And then once we meet in our next session, we're going to do these 2 questions, and basically I'll show you how to do the question for group account in an exam setup. So what I request you to do, can you first of all revise what you have all done on computation of goodwill, how to deal with the various consolidation adjustment, also revise what you have done as far as the 2 questions are concerned. And then once we meet, we do these 2 questions in just one session, and then we wind up with that topic. I don't think once we do these 2 questions, we'll be able to come back here, because definitely we don't have time. Remember, we are saying now from tomorrow, we'll just be having 6 sessions which are remaining. We need to do something to do in theory topics, and also we need to do something to do with accounting for conversion of partnership into a limited liability company. So therefore, you need to do a lot of your own. Make sure you revise all what you have done, try to attempt these particular questions, and then once we meet, I'll just show you how to handle such question in an exam setup. Maybe we just take 1 hour for one question, for the other question just 1 hour. Sasa? Yes. So for today, I want us to stop at that particular point. I don't know whether there is any question before we wind up.